Welcome to Module 2, Cash Flow Cycle. Cash flow is the lifeblood of every organization. An organization cannot run without cash. It doesn't matter the size, the age of the company. Without cash, a company cannot exist. So in managerial finance, from both perspectives, as an analyst looking in and looking within the company and managing the company, cash is probably one of the most important things. What I'm going to do is I'm going to introduce you at this point to the Geneseo Coffee Company. And this is a small case study that I made up. And what we're going to do is we're going to walk through Geneseo Coffee Company. Then what I'm going to do is walk you through another company. And then your assignment will be to work on these concepts for the two companies that you've selected in Module 1, your first assignment. So let's take a brief look now at Geneseo Coffee Company. The company roasts coffee beans and sells them to independent coffee shops and restaurants in upstate New York. Their competitors are Finger Lakes Coffee Roasters, Boulder Coffee, and Coffee Connection. The company recently earned the Best Robust Coffee Award at the International Coffee Conference in Vienna, Austria. The company operates in a warehouse right here in Geneseo, New York. They have 5 coffee roasters, one of which was purchased in 2012. In year-end 2013, they sold 2.5 million pounds of coffee. The legal form of ownership of this is a corporation. So now let's start. What is it that Geneseo Coffee Company does? And I've simplified this. So what you're going to have to look at as you go forward is what are the complexities that go into this. Every business has a business flow cycle. And in this business flow cycle, the first step is they have to buy coffee beans. Once they buy coffee beans, they need to roast the beans. After they roast the coffee beans, they need to sell the coffee beans. Then they get paid for the beans, and then they can buy more. So really, their cycle: buy the beans, roast the beans, sell the beans, get paid. This is their business flow cycle. So let's look at what happens at every step of the way. Well, when you buy beans, there's some process that needs to go on here. You need to identify potential suppliers. You need to determine the price, how much you will pay. What are the specifications of what you want to buy in beans? How much do you want to buy? Now, when you're thinking about how much coffee beans, the raw beans you want to buy, you have to do that based on anticipated future sales. There is also a time for delivery of the raw beans. So you have to say, okay, if I need these beans to sell in August, I need to order them in May. So there's a lead time that goes in here. So now we have to back off again and say, if we're going to have these sales in August, it's going to take us 30 days to roast them and package them. We need to have the goods in place July 1st. Now, if it takes 60 days to deliver the goods, we need it to order this by May 1st. So there's a process here that needs to take into that. We also have to manage at this step our inventory levels. Now, when you're looking at this, sometimes we may get lucky and we may be able to get credit from the seller, the supplier of coffee beans, or we're going to have to pay them up front. Either way, resources are needed for this. People are doing this ordering, and they have a cost. Okay? You have to pay them on a weekly or every other week basis. Now that's before you even get any of the beans. Now, depending on your terms, as I said, you may need cash to actually order. Next step, roasting the beans. Well, you need to have a process or an inventory and resources to be able to roast beans. So you need to have the beans themselves. You need somebody, though, to receive them, put them in inventory, but then you need space to do that. There's a cost to that space. Then you need to roast the beans. So you need somebody to put them in the roaster, run the machinery, you need utilities, bags, and other supplies. Then you have finished coffee. Value has been added at this point. So the raw beans are now worth more because you've done something to them. So the question then becomes, when are these costs expended? Well, these are costs, again, are expended before you sell the beans. Now we get into selling of the beans. Well, you need to have salespeople who interact with customers, not just to make a one-time sale, but to build relationships, to secure the customer order. Once the order is received, okay, you get the order, somebody again has to process it. They have to package the desired quantity. If I want 50 bags, well, they have to put a package together of 50 bags. They have to ship. Now, how are we going to ship? What's the delivery method? How long does it take to get from our warehouse here in Geneseo to the customer? Then we're going to have to bill the customer. Some of them, question becomes, well, when do you get paid? Well, terms with customer. When will they pay you? Will they pay you on delivery? Will they pay you in 30 days? What are the terms? Then you will finally get the funds. You now can take the cash or the check or the other payment type to your bank, and voila, you now have cash. Well, what does this mean? Think about this for a second. The business takes time to operate. Think about it first from the beans. Just think about it. You need to decide what to do with beans. Cash goes out, and cash is going to continue to go out until the very last step in the cycle. So cash, the business process takes resources to operate, and cash is needed to make the process work. So there's a time period where cash is going out but not coming in. The firm itself needs to provide that cash so that the firm can operate. Now, that's what we'll call the cash flow cycle. If you look, when you buy the beans, that matches the business flow process, and cash goes out. Then more cash goes out when you roast the beans. Then you're going to sell the coffee beans, and you still have cash going out. You don't have cash coming in. Then you get paid for the beans, and there's cash in. So when we're looking at this entire cycle, you need to have enough funds to be able to make this process work. If you don't have cash at this point, you can't roast them, nor can you sell them, nor you get paid. So that's the cash flow that's needed. We need cash in the organization. So if we look at it from a working capital, buying the beans, okay, so what is the entries of this? I'm going back to accounting because remember I said that the most important thing is debits equal credits. Well, when you get the material, the beans, you're going to debit raw materials inventory, you're going to credit cash or accounts payable. At some point, cash needs to go out. When it goes out, whether it's a day, 2 days, or 30 days, you're going to debit accounts payable and credit cash. So you need cash for that. So those are the entries. Balance sheet, balance sheet, balance sheet, balance sheet. Nothing has impacted the income statement yet. You've now roasted the beans. You're going to use raw materials, labor. You need to expend cash. So what's the entry there is work in progress inventory, debit, raw material, credit, because you're taking it out of raw material, put it in work in process, and then your cash or accrued expenses. So you're either, right now, you're paying for it or you're going to pay for it shortly. So now that's the entry. Notice these are still all balance sheet items. So when we're looking at the working capital cycle, it's still within the balance sheet. Now, when you sell the beans, there's the cost of selling, including shipping. So what you're going to do is debit selling expenses, credit cash or accrued expenses. Entry 2, accounts receivable, and then the credit finally goes to sales, and we now need to transfer the cost of sales out of the inventory, which is balance sheet. So what you're starting to see, it isn't until this last step that we start putting something into the income statement. Because remember, we're matching. We're having the financials tend to follow the business cycle. So this is an income item, but again, where it's coming from, you need to fund it. So it's a balance sheet. Now, you haven't gotten paid. You can recognize the sale, but you still haven't gotten the cash. But now you're transferring inventory that was previously an asset into cost of goods sold. So what does it mean? The business and cash flow can be measured as to time and dollars. Okay, so when we go back to this here, right here, what you're going to see is we can measure the time that it takes to go from here to here, from here to here, from here to here. So we can measure this in days. Okay, so that if we sell everything for cash, this cycle can be very short. But we can always measure each part of this process. And if we can measure the process, the time frame here, we can also measure the dollar amount that we need at each one of these. Why does this become important? So that we can provide cash. If we want to grow our sales, we are going to need to buy more coffee beans, which is going to require more cash, or we need more working capital. So as we now move, let's go back to where we were, is this can be measured as to time and dollars, which I just said. The faster the cycle time, the faster the cash moves. Cash is needed for a shorter time and can be redeployed faster. So but you can only deal with so much speed in the cycle because there are different limits in there. If it takes 60 days to get the beans from the time you order them till you get them, and that's not within your control, well, you can't do anything. But if you could find a supplier who could perhaps do this in 30 days instead of 60, that's a way to speed it up. So we're looking at it, each step, as I said, requires cash until the cash comes in from the final payment from the customer. So the slower the cycle, more cash will be needed, and it will need to be deployed for longer, and the total absolute amount of cash needed will be more. And the question is, can I compute the cycle time? And I said yes. And yes, you can measure this, the cycle time, based on financial data. Then we can evaluate it, and then we can determine if what it is, quantify it, and measure and determine the cost of working capital and how much working capital you need. So that gives you a sense of this cycle in working capital. It's got to come back to the business. What we're going to do now is take a brief look at the Geneseo Coffee Company, the financial statements. I'm going to give you a brief introduction to the Geneseo Coffee Company from a financial statement perspective. You're going to find this worksheet under Module 2, and it's entitled GCC Module 2. When you bring it up, you're going to see a number of tabs on the bottom: financials, definitions, working capital, cash flow, free cash flow, and then the worksheet. So back to my process, I'm going to review the balance sheet of Geneseo Coffee Company to give you an introduction. Then we're going to go back, do some more definitional work. Then we're going to come over, apply those concepts to Geneseo Coffee Company. Then I'll show you how to apply them to another company. Then I'm going to let you go do it for a couple of more companies. The goal is for you to really understand what's going on with cash flow in companies and to get you comfortable with the terminology and the methodology. So let's take a look. This is the Geneseo Coffee Company. It's a very simple company. And the first thing we're going to look at is the balance sheet. Very simple. There are 3 dates. This reads 12/31/13, 12, and 11. Now, I'm reporting them going right 13, 12, and 11. Not all companies will do that. Some will go 11, 12, 13. So you got to be aware of what it is. What are the assets the company has? Well, in this case, it is actually pretty straightforward when you look. They have cash, They have accounts receivable. People owe them money. They have inventory, and that gives them total current assets. So what we can observe from this is that from December 11 to December 13th, they have increased their current assets. And if we look at the components, we can see that cash is up, accounts receivable are up, inventory is up. Okay? So these are assets that are used in the working capital cycle. So if we go back over to buy the beans, roast the beans, sell the beans, get paid for the beans, all of this is part of that process. Then we have property, plant, and equipment. These aren't current assets. These are assets that are going to benefit multiple periods. So these, if you want to look at it, this is what's needed to make the working capital cycle run. These are the things, this is the long-term assets, those things that'll be there for multiple cycles. So this is the equipment, okay? The roasting equipment, the bagging equipment. So now you say, okay, that's great. So we know they're using $1,360,000 to run the day-to-day business. Then 800 is used longer term. So you have to distinguish, this is an operational and this is a longer term concept. Now, let's look at the other side of the balance sheet, which is liabilities and shareholders' equity. Well, they have some long-term debt, we can see here, but a portion of it is due within the next 12 months. They also have accounts payable, they owe vendors, and accrued expenses. Accrued expenses is what they owe for payroll taxes, employees, sales tax as appropriate. So they have $554,000 some dollars in current liabilities. And we can see that that has went up and now it's going down. We can see long-term debt. This is debt the company has borrowed, and this amount is not payable in the next year. It's payable beyond that. Next thing is shareholders' equity. When we look at shareholders' equity here, what we're seeing is they have preferred stock, and there's 3,000 shares issued and outstanding, 10% cumulative interest or dividends, no maturity. Now, preferred stock is a it's equity, but it also has some features of debt. So preferred stock is equity, but it has a generally fixed dividend, and it oftentimes has a maturity or it doesn't. It has preference as to payments of dividends. So it has a defined dividend, and it has a preference in bankruptcy. Now, so if you're going to look at what could happen in a bankruptcy proceeding, the secured creditors, long-term debt, would be paid first, followed then by unsecured creditors, those with accounts payable. Then what's left over would go to repay the preferred stock, and then the rest is left over for shareholders. So this is a quasi one here. Then there's common stock, and that's the ownership of the company, 100. And in this case, the next line is retained earnings. And this retained earnings is what the earnings that the company has kept. It hasn't paid them out as dividends. So this is money retained. So when we look at what the total shareholders' equity is, we add preferred stock, common stock, and retained earnings. Now this is a very simple balance sheet, and we're going to see many different things down here in retained earnings as we move forward. But I've combined it all into one so that you can start to get your hand around it. And as you can see, debits equals credits. So you got $1,360,000 to make the working capital cycle work, $800,000 in property, plant, and equipment. How have they funded that? Well, current assets, which is current portion of long-term debt accounts payable, $554. $700 is funded by debt, and the remaining $900 is funded by equity of the company. Now we're going to take a little bit more look at capital structure as we move along, but of that $2.1 million, you can see how have they funded it or provided money to run the company. Now looking at this as cash as to how the company runs is a little different way of looking at it than a historical balance sheet. Let's come down now to look at sales. Okay. Now, some companies use the word sales, some use revenue, or anything else in between. So you got to look at carefully what that is. And as we can tell, this is for the year ending. Always need to see whether you're looking at year, quarter, and again, right to left or left to right. So we can see sales last year were $6 million. But compared to where they were 2 years ago, sales have gone up substantially. Then there is the cost of goods sold. This is the cost of those $6 million. That's $4.8 million in this scenario. And then it gets us a gross margin. It's gross profit, gross margin. Basically, that's the difference between what you're selling and the cost of what you're selling. Gives us a gross margin. Now, there's other expenses that aren't part of the cost of goods sold, but they're part of running the company. The cost of selling, the cost of running the company, audit expenses, legal expenses. So if we're looking at this, 4.8 is really the roasting, buy the beans, roast the beans. This is sell the beans, get paid for the beans, running the process. Interest, this is the interest expense on the debt. So if they have this 700 plus 100, this 800,000 in debt, the interest expense was $38,000. Income before taxes, which is the $1.2 million less 850 less 38 is $312,000. Taxes, 93.6, and that's an effective tax rate of 30%, which is 93.6 divided by the 312 is that. So their net income was $208,000 last year. They paid preferred dividends. Okay, remember this is part of the equity. So that comes out of income. They started the year with $316,950 in retained earnings. Going back up here to the balance sheet, you see that. And then retained earnings at the end of the period are $505,360, which is up here. So this gives us a picture of the sales and the cost of sales. Now, obviously you want to, and you're doing analytics, you're going to want to go deeper. But we've created this as a very simple model so that you can get the concepts with it, and then as it goes forward, you will continue to learn. So if you get this for Geneseo Coffee Company, and you'll start to get the rest of it. And if you do have questions, make sure you ask, because remember, I know some of you are accounting majors, and this is really easy piece of cake, but others of you who may not have a strong accounting background may need to take a little bit more time or ask more questions. Next important statement is the statement of cash flows. And in the statement of cash flows, I think this is probably one of the most important statements you will ever look at about a company. Because balance sheet's giving you a point in time. Income statement is what's happened over a year. But I think some of the key of this is really understanding what is the cash flow. So if you're looking at this section right here, cash flow provided by operations, I'm just going to highlight this for you. The cash flow provided by operations, that's where money is coming from. Okay? And highlight it again, is that cash flow provided by operations, used in operations, starts with net income. We add back depreciation because it wasn't cash. So we're looking at cash flow. So since depreciation is a non-cash charge, we add it back. But then we're using different amounts in operations. So we've had to increase accounts receivable. That used cash. We need to increase inventory. That used cash. We reduced accounts payable last year. We went from 633 to 454. That took cash. So last year, operations used cash as opposed to providing it. So operations can either provide cash or use cash. It's not, you need to understand this. What are they doing with their cash from operations. You do want to tend to see it positive, that operations is generating cash. But we can see on these three lines, they've put it back into the business that operations use more, which is funding the cash flow cycle. Well, they then cash flow from investing. Investing includes purchase of property, plant, and equipment. So if we look at that, what we're seeing is that they bought $425,000 in equipment and $70,000 the previous year. So they used $425,000 in cash. Now, these are neither good nor bad. You need to evaluate them. So basically, operations used $325,000. Cash flow was, they needed $425,000 to buy equipment, so there was a gap. So they had to somehow come up with enough money to pay for that. Well, they issued preferred stock. That generated $300,000. They paid back long-term debt, and then they borrowed $600,000, $30,000 of dividends. So financing activities provided $820,000. So they had to go out and fund this growth in operations, this investment or the fixed assets they purchased, and they did that by issuing preferred stock equity and by borrowing money. They did do some repayment of debt, and they paid dividends. So if you're looking at this, $820,000, they started the year out with $70,000, and they increased cash. So if we're going to look at $325,000 we used for operations, $425,000 which was investing activities, we funded, got money in of $820,000, there was an increase of cash of $70,000. So if we started the year with $80,000 and we had cash flow of $70,000, cash ends up at $150,000. So in this year, 13, more cash went out for operations to fund the growth, because remember, we saw it grow 4, 5, 5, 6, and that costs money to do that. Cash is what it cost. May not necessarily translate into income the same way, but it's how the cash was used. This becomes critical in understanding the company, because we know in this point they did certain things to generate cash. When we look at what happened the year before, income operations actually threw off $150,000 in cash. Of that $150,000 in cash, they spent $70,000 to buy new equipment, and they repaid long-term debt of $50,000. So in this case, operations paid for everything that was needed. They didn't need to borrow. They didn't need to issue preferred stock. But cash still went up, and you can see net increase in cash, cash at the beginning of the period, cash at the end period. So what I'd like you to do now is take a minute and just follow through and take a look at how these numbers work. If you need a definition, I'm not going to go through this right now, but if you want to walk through, this talks a little bit about everything I talked about, but tells you what's in the different categories. Cash, there can be different layers of cash, marketable securities, accounts receivable, but you can read through this. I don't need to go through this. I'd like you to read that. And then when you're done with that, what I'd like you to do is go back and we're going to take a look at working capital definitions. So the first thing that you should walk away from this, cash flow is the lifeblood of the company. Okay?